Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei, it's up over 1%, and the Taiwan index too is holding in the green.
We need to take out 25,317 levels, which is the high of the week. 25,260 on the Nifty. It's up, but up small. 82,840, 850 on the sensex.
More than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years.
The Nifty, after hitting highs of in excess of 25,400 in today's session, has cooled off.
Mega 25,000 crore rupee proposed share sale through a qualified institutional placement or QIP.
Good uptick that we're seeing in the frontline indices. The sensex is also trading with gains of around 0.6%.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and my co-anchors will join in just a bit from now. But for the time being, we've got a party going on the Lal Street. Forget about 25,000. 25,500 is here. The Nifty Bank has gone ahead and made a fresh all-time high, clocking that to 57,200 odd mark. And the big boys have come to the party. So you have Reliance Industries, that's holding one end up like a rock. HDFC Bank, the other one that was a little bit subdued, but that in fact has come back into its own after a brief consolidation. And just take a look at that nice trending up chart is what you have on HDFC Bank. And pull up a couple of other names as well that are just coming into play. Eternal, that stock, remember, at around 225 rupees, we had made this point that there was two big global rejigs that were taking place. But there was a lot of demand coming in from the domestic mutual funds, and they were sitting on a lot of liquidity. So that nearly $1 billion got gobbled up. And after that, in fact, you've seen that the stock has not looked back currently at the high point of the day as well. Okay, also throw in there a couple of other names. You have Ultratech Cement that's now up close to 2%. ICICI Bank as well as higher. So short point being, today is a good trading session, though you'll wonder, my portfolio is not looking so good. The problem is that the number of stocks advancing as well as declining, they're not reflecting what's going on the headline index. So it's been a bit of a switch of roles today. Breadth of the market, pretty much okay. Headline index zooming away. Mitesh Thakkar joins us on the show. Mitesh, is this the moment? Is that now are we gunning for higher levels since we have taken this out decisively? I'll tell you what, Mitesh, the observation of the last few days was the bears were getting very, very confident. They were writing calls. A 25,300 call was getting written a lot. And once you saw the 25,400 mark getting decisively crossed, it appears, there have been quite a bit of the short calls that have got covered. Your take?
Yeah. So, Nigel, my understanding is that, getting past 25,200, 250 yesterday suggested that we might test 25,500. We've just done that. And there's no sign of weakness as yet. So, good chance that we might see an extension. Players who want to enter afresh would wait for an intraday decline, but otherwise, people who are holding it out should just trail their stop loss to about 25,360 odd levels, and 25,750, 800 is the next target area. So stay positive on the indices. Even the Bank Nifty, has managed to get past 56,800, so that's a positive sign, and Bank Nifty could head towards 57,500 as well.
Okay, got it. All right, that's a positive sign. Agreed, Mitesh. What about individual stock calls? What's on your radar?
I have a buy on National Aluminium with a stop at about 188 and a target of around 200. And MRF, the other one, MRF is given a good reversal. So buy here with a stop below 1,41,000 and target of around 1,43,500.
Got it. Yeah, it's a 1,40,000 stock. Wow. Thanks a lot, Mitesh, for joining in and filling us in with those details. But, it's the afternoon, so let's focus on a drink. That's United Spirits. It's in focus. Kotak Securities has written a bearish note on the stock. Teetotaler Mangalam joins us to tell us more about that note. Mangalam, they as well are not having a sip.
They are not having a sip because the tipple has gotten a little expensive as per them, and that's thanks to the Maharashtra government increasing the excise duty after so many years. And that's exactly the risk that they've put back on the table for all these stocks. So if you look at it, it's the first brokerage that has finally put pen to paper, done analysis on how prices are pre and post the excise duty imposition, and they've determined that it's a 30 to 45% increase in retail price for popular lower prestige and mid prestige segments. How much do they account for their overall sales? For Maharashtra, it's about 11% of sales value and 13% of volume. Overall, Maharashtra is an important state for United Spirits when it comes to revenue and EBITDA contribution. So Maharashtra accounts for nearly 16% of their sales, of which 11% comes in from these categories where the prices have risen by 30 to 45%. Importantly, for the upper premium and luxury segments, the prices have not been, increased by as much. In fact, it's between 0 to 8%, but there is a big volume dent that they expect. But beyond that, they believe that, this reintroduces unpredictability around policy, and that is where they've, gone ahead and cut their EPS estimates for the next 3 years by anywhere between 3 to 6%, and they've cut their target price as well from 1575 rupees to 1475 rupees. The important triggers to track from here on: Delhi is due for an excise policy. Will that be in favor or not is the big question. Then there are Bihar elections in November 2025. Remember, Bihar is a dry state right now. Post that, will there be a change in thought process out there? And thirdly, the formal implementation of the UK FTA is something that the industry is awaiting. So, there could be mild positive triggers right now, but unpredictability definitely back on the table.
Got it. All right, Mangalam, thanks a lot for that. Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, joins us on the show. Hi, Sudeep. What's your view? Kotak not too optimistic. Mangalam says the peg got too stiff. What do you think? Will you be looking at this dip to get in, or you rather stay away?
Well, I'll rather wait, Nigel. I think, as Mangalam was listing out, I also believe there are many moving parts, and one doesn't know which way things will move in the near future. Look, valuation is also not really cheap. It is valued reasonably well. And at this stage, the margin of error is very limited. So I'll rather wait out.
Got it. All right. You'd rather wait out on that particular one. Let's focus on a couple of other stocks then. Sudeep, I wanted your view on Eternal. The stock, I was mentioning this earlier as well, and I think a month or so ago I pointed it out on the channel in the morning, that there was going to be a rejig in that one particular week, if I'm not mistaken, 3 weeks ago, and there was close to around $850 to $900 million of selling. But the point was that the domestic mutual funds, well, they were very, very active in the counter. They were sitting in a lot of liquidity as well. And all of that got absorbed. And in fact, by the end of that week, from 225, the stock ended at around 235 with that sort of selling. That told you there's a lot of interest in the stock. But at around 265, what do you think? We know the kind of usage is just going up, but valuations, profitability, what would you think?
Well, Nigel, a couple of things happened. One is, as you rightly said, the company had announced that they will focus on growing the business, particularly the quick commerce, which will require a lot of investment. And they were very clear that the profitability will take a hit in the near future. So that was an announcement which market, of course, understood, but there was some correction. And then, of course, came the fact that they talked about limiting the foreign shareholding to 49% to ensure that the business can grow in a manner they wished. Again, that was a negative, and market kind of assumed that the stock will be under pressure. But I think the fundamentals of the business and the strong demand which the business is witnessing and the leadership position which the company enjoys, I think gives them a unique position. And I strongly even then had mentioned that this is some business where winner takes it all. And they are clearly the winner, whether you look at Q-commerce or whether you look at food delivery. I think they are leaders and their parameters are improving in all these businesses. The second listed company, Swiggy, is a little behind, or why should I say a little far behind them in most of the parameters. So I think if you want to be in this space, I think Eternal is the company to be into.
Got it. Okay, all right. Sudeep, the other one that's woken up, and that's the giant, HDFC Bank and Reliance Industries. You're talking about more than 20% of the index that went through a phase of underperformance, but boy, oh boy, they have got their mojo back in style. What's your view on both these two names? Good for more?
Well, Reliance definitely is. I think we have been always positive on Reliance, and we have been maintaining our view for last 6-8 months that I think this is a sleeping giant. A lot of opportunities, particularly the value unlocking opportunities, definitely there, and it's a matter of time before it happens. Whether it's a retail or the telecom business, some value unlocking will happen. The other fact which I think is adding to this, the thinking is that the GRMs. I think this quarter we will see a positive surprise on the GRM front, and the business itself, the old business or O2C business, will see a lot of positivity coming back. While the telecom and the retail was giving positive vibes, the O2C, particularly in the petchem side, there were a lot of challenges, but I believe that things are improving there as well. And, the business numbers also will improve significantly.
All right, got that. Still positive on Reliance Industries, went through a period of underperformance. And if you just take a look at Reliance Industries as well as the Nifty, year to date, you'll see that Reliance Industries has found its form, and it's found its form in style. The last 6 months have been very, very good for investors in this particular name. But let's get straight to a CNBC-TV18 exclusive then. Sources tell CNBC-TV18 that the insurance regulator is unlikely to cap commissions. Yash joins us to fill us in with more details and tells us what does this mean and its impact on the insurance sector. Yash, take it away.
Well, Nigel, if you simply talk about commissions and expenses of management, commission is a part of expenses of management. There are two things under expenses of management, commission and operating expenses. Now, before FY23, the regulator had caps on individual business commissions like motor commissions, fire commissions, health commissions, so on and so forth. In FY23, the regulator said, let's do one thing, let's remove individual commissions and put a cap on expenses of management straight away, giving insurance companies more flexibility in terms of how much commission they want to pay to acquire any business, and balancing it, still staying under the limit of expenses of management. The fear, as far as the street is concerned, was that this comes under review in FY26, and the regulator might look at bringing that limit back onto commissions. What that would do is that it would restrict business, it would restrict commission payout to aggregators like Policybazaar as well. What we've been given to understand from our sources is that the regulator believes that policyholders have been benefited through limits on expenses of management, and hence, purely from that point of view, there is no need for that policy to change, which means for the limits to come back on commissions from expenses of management, which means the regulator believes that the limit on expenses of management should continue as they are today. What that does, of course, it gives more flexibility to insurance companies to pay how much commission they want to acquire individual businesses. At the same time, it benefits a company like Policybazaar as well, because the commission income is the main income for them. So this is essentially how it works, and exactly why it will be beneficial for insurance companies as well as for aggregators and other distributors.
Got it. Okay, all right. Yash, thanks a lot for joining in and giving us that quick take. Sudeep, any view on this one, PB Fintech?
I think, we like the stock. In fact, the business is solid, and core business is growing rapidly. And the potential, of course, is humongous. They are in the right spot at the right time. The only, the issue which still bothers me is that investment in the healthcare space, which probably they could have avoided. And I'm not sure the logic and the rationale behind that still. They are talking about, limiting their investment and a whole lot of other things. But in spite of that, the logic of that still kind of is not easily digestible. That's the only niggling worry. Otherwise, business is strong.
Got it. All right. Sudeep, I wanted your view on the cement stocks. And the one that I'm going to talk about is Dalmia Bharat. Prabhudas Leather, they have come out with a note on Dalmia Bharat. They've had an interaction with the management, and they maintain their accumulate rating with a target price of 2,273. They are valuing the company at around 11 times on a forward EBITDA, so 11 times EV upon EBITDA. Let's run you through the rationale. They expect Dalmia Bharat to actually be a big beneficiary of the higher prices in South as well as in East India in the first half of this fiscal. And they have broken it up into various aspects. So point number one, on demand, they say volume is expected to take a hit in the first quarter. That's because of the sluggish demand, especially in East amid the monsoon. While southern region, demand was a little bit better than East, but now it's getting affected because of the monsoon as well as flooding in various regions. That's point number one. Point number two is the good part with pricing. In East as well as in South India, pricing is higher by around 12 and 35 rupees a bag. This is in comparison with the average that we saw in Q4. So even after the recent price pullback that we have seen in the month of June, cement prices are still up by 10 to 15 rupees higher in comparison to Q4 FY25. Point number 3, what does this mean in terms of an EBITDA per ton? They're saying the improvement in near-term performance is likely to be led by higher pricing and flattish cost structure. This in turn would mean that the EBITDA per ton improves by around 200 to around 250 rupees on a sequential basis from the levels that we saw in Q4 FY25. So that's a big thumbs up out there. Pricing is going to play its role. Costs are more or less flattish. Big uptick in terms of EBITDA per ton. They're also saying in a longer term, the management is confident of achieving cost savings of around 150 to 200 rupees per ton. That's by FY27. And the few factors that they've laid out is improving their renewable energy mix and also reduction in logistic costs. So that's the longer term plan in terms of cost reduction. Finally, on capacity addition, they've already announced 6 million ton expansion at Belgaum as well as in Pune. The capex they've laid out is around 3,500 crores. And this is expected to be completed by the end of FY27, which by that time, the total capacity will move up to around 55.5 million tons also. Put all this together, Dalmia Bharat, one of the big gainers today. Sudeep, what do you make of this one? Dalmia Bharat went through a big price correction, but now in fact, it's getting its mojo back. And as PL Capital has mentioned, all those factors, favorable pricing, demand not so great, but input cost flattish. They like it. Your take?
Yeah, absolutely. I think overall cement, we have been positive, and particularly the leading cement companies, we are holding our positive view. And PL is absolutely right in terms of one particular factor, which is the cost. I think the cement companies have achieved commendable cost control, and the expectation of costs going up is very, very limited. So in a scenario where the demand is increasing, and believe me, it will keep increasing. Q1 is a monsoon season, so obviously demand is slightly sluggish in different pockets of the country in Q1. But going forward, demand will significantly move up. So the pricing power, which is already back, will be even more. And with that pricing power, costs being flat or even coming down going forward, I think the EBITDA margins will keep increasing and demand is increasing. So obviously they're going to have good time. Yes, Dalmia Bharat still can move up about 10% from here. That's what we believe. And of course, our pick has been Ultratech Cement for quite some time. And we maintain our view that, if you want to be in this segment, be with the leader, which is Ultratech.
Got it. Okay, all right. You like Ultratech more than any other stock. By the way, keep an eye out on Vedanta. That finally seems to be waking up. So I think we should get Vedanta up for you on the screen. In the first week of July, I understand some of those procedural issues will be coming up for NCLT hearing and the likes. Big move is what you're seeing. It's been a bit of an underperformer in the last couple of weeks. But that one today, it's a pure play on the weaker dollar index, better commodity prices. You've got the special situation that's playing out there. And the promoter entity should be in better shape going by the dividends that they're paying out from Vedanta Limited, and that's why Vedanta Resources will be in far better shape as well. But let's focus on some flashes that were down on the screen for you. A deal seems to be impending in the paint space. AkzoNobel's on the block, we know that, but Ashwin Mohan from Money Control joins us to fill us in with more details that he's picking up. Ashwin, take it away.
Good afternoon. So this is a really big and colorful deal that has been in the works for the past few months. What I'm given to understand from my sources is that Parth Jindal led JSW Paints, which is of course a group company of the diversified conglomerate JSW Group. So JSW Paints and AkzoNobel NV, we're given to understand from our sources, are likely to shortly sign the final or definitive documents over the next few days. And this is for the proposed acquisition of the majority stake that is held by the Dutch multinational parent in AkzoNobel India, which is the listed entity. At the end of day's trade on June 25th, the majority stake of 74.76% held by the Dulux Paints maker in AkzoNobel India was valued at around 10,985 crore rupees, but reports have pegged the deal value at around 9,000 crore rupees. Now remember, Money Control was the first to in fact report back on May 15th that JSW Paints had emerged as the frontrunner in this hotly contested transaction. Clearly, it is now entering the final leg. There were other suitors as well, Advent along with Indigo Paints as well as Pidilite Industries, but JSW Paints has pipped them. What our sources are telling us is that both parties are planning to seal the deal very soon, maybe as early as this week or early next week. And post that, an official announcement can be expected. Keep one thing in mind, JSW Paints is a relatively new entrant in the space. It entered the paint sector in 2019. This acquisition is expected to bolster its presence in the decorative paint segment. And of course, it also stands to benefit from the popular Dulux brand. Also, this proposed acquisition comes at a very interesting time for the entire paint segment, where you have the market leader like Asian Paints, some of the established players like Berger Paints and Kansai Nerolac. They're all facing increased competition from the likes of Birla Opus and other players. So very interesting time for this deal to enter the final stage. Let's wait and watch for the action to unfold in the next few days. Back to you.
Got it. All right, Ashwin, thanks a lot for that. We'll have to keep an eye out on that one. JSW Paints likely to soon sign the final pact for AkzoNobel. Sudeep, before you go, tell us, will this paint a better picture? This has been a deal that's been, long awaited. Finally likely to see the light of day. What's your take?
Well, it's an interesting transaction. It's been, as you rightly said, pending for quite some time. So yes, it's good for JSW Paints because they are new in this business, and this acquisition will definitely give them an edge in the at least in the premium end of the market. But having said that, overall in the paint industry, we are very careful. I think the competition is too much, and at this stage, it's better to avoid the paint companies just because of the sheer intensity of the competition which we are witnessing in this segment. Yes, the oil prices coming down will definitely lead to some cost benefits in the near future because there is a lag between the time prices come down and it gets reflected in the P&L of the paint companies. But that benefit will definitely come. But in spite of that, I think the competition is so intense that it's little difficult to predict and enter any of the paint company stocks at this stage.
Okay, little tricky. And we're waiting by for, that kind of competition that's been intensifying. That's what's led to a lot of them being under pressure. But thanks, Sudeep, for joining in, giving us your view on that particular name. By the way, the stock we just highlighted, Vedanta, that's taken off actually. Vedanta has moved to the high point of the day. I think Hindustan Copper as well. The metals pack itself has come back to life in the last few minutes. All of them moving to the high point of the day. For the time being, we'll slip into a short break. We'll be back. N. Jay Kumar from Prime Securities is waiting by.
Welcome back. Well, Nigel was holding up the fort on closing bell. The full team is back. Good-looking screen. 250 points on the Nifty. 25,500 is where we are at. So actually, I mean, we're plateauing out a little bit as we speak. But, I mean, can't complain. For the week, by the way, we are running at about 1.5, 1.6% of the Nifty so far. So a little bit of hesitation early on after that ceasefire, but since then, for the last 2 days, pretty solid gains. N. Jaykumar is now with us. He's Group CEO and Managing Director at Prime Securities. Jakes, good afternoon. Great to have you with us here. Thanks very much for your time. You know, let me, a slightly convoluted question, if you will permit. You know, you got this Springboard initiative, right? And you are, I know for a fact that you are working with so many smaller companies, startups and the like across a range of industries. Could you use, your read-through across those businesses to look at, I mean, I'm sure that throws up ideas in the listed space as well, right? At the end of the day, the listed space is much more liquid, etc., maybe higher valuation. But anything you can kind of sort of, share, cross-linkages, any ideas you found, any segments which are very exciting in the private markets, maybe you found a play in the listed space? Go on.
So I'll tell you, for instance, the FMCG space, it's been a sector that we've pretty much ignored in the listed space. But if rural consumption is indeed coming back, some of the companies that we're raising money for are actually well dovetailed and networked into the rural demand segment. So while consumption itself, as I said, has been expensively valued in the secondary markets, it's possible, and we've not even had growth. So you have many of the multinationals now quoting at 40, 50 times like they've been, but growths are in low single digits. If you just move to the unlisted space, you'll find a lot of very good opportunities at 2 to 3 times top line, growing at 30 to 40%, and occupying a niche which one fine day will end up in them getting consolidated and being bought into by some of the big guys. Because in the 0 to 50 crore kind of range, there aren't too many product categories that are being nurtured by the existing, the bulge bracket FMCGs, if you will. So that's one space we kind of like, where in order to make up for the growth that they lack in as listed companies, they're able to acquire small niches or small slivers of markets and are able to do so with high growth, which is hugely beneficial for them. They're also cash rich, many of the FMCG plays. So a combination of being cash rich, not having the ability or the inclination to nurture small companies, and then getting to a stage where, let's say, these companies are 50, 75 crores in top line, sometimes even could be 3 digits and above. They become very ideal candidates for these sort of agglomeration or consolidation that I talk about. So that's one thing that makes us want to go for FMCG spaces in the unlisted, but that's not a space that we actually look at in the listed. That's not a space we look for in the listed peers. So that's one paradox I can sort of straight off the bat talk about.
I mean, and here valuations are much more reasonable as compared to if you want to buy FMCG in the listed space, right? As you said.
So the way that happens is folks typically, or investors typically pay up for growth. And if you don't see growth in the secondary markets, whether it's, other than passive funds or index funds who actually need to deploy something in the FMCG space as a diversification, anybody seeking growth is not coming to the FMCG space today. They will do so in the unlisted space because that's where you get growth. Maybe you got to pay up a little more for growth. But if the company actually comes good, then that could potentially be a multi-bagger in the unlisted space, as long as the final fling, which is either a listing or a consolidation with a listed peer, can happen. Many of the names that are today listed in this space came from being unlisted, where people paid for growth. So that's something that I can talk about.
Okay. So perhaps when it comes to FMCG, unlisted better than listed. Jakes, hi, great to have you on the show. Just, an overview overall on what you think of the market as well. We've just been discussing this internally, The markets have managed to climb all walls of worry, tariffs, bombs, nuclear, this, that, whatnot, marching higher. What's the sense? Do you think there's an element of maybe complacency, or is it market wisdom that there's no real disruption in terms of corporate earnings or inflation or anything, even on account of the tariffs so far?
Well, all I can say is that there's less and less credibility and less credence given, other than in the immediate 15 minutes, to Truth Social kind of announcements. So I think we've got used to pronouncements and policies being made on Twitter and the social media. But I think the markets are now learning to ignore that, are learning to move on, and are learning to take that volatility in their stride. And especially if you look at the broad directional call, the dollar index, as I speak, is firmly in heading downwards. It's broken its last support at 97. It's now into the 96 handle. The some of the commodities are hitting new 52-week and multi-year highs. Copper, for instance, is at 5.06. So you're talking about a movement away from the dollar, a trend that gets interrupted by wars and stuff like that. But the moment you sort of assume that wartime phenomena at best last for a few days because nobody really wants a war, and once that's out of the window, markets are heading. So the broad directional call is the Indian markets are heading higher. Every dip is being bought into. Every nervousness is being sort of bought into by funds. And while we do see headline numbers of foreigners selling on the secondary markets, but they are big buyers in the primary, in the blocks, etc. So my own assessment is that money is coming into the Indian markets, whether it's FDI or it's FII, but you don't see it on as regular a basis as you should be seeing. The locals are flush with money. They continue to buy into. So it's really the HNIs who have taken a combination of Ukraine, tariffs, and the Middle East to heart and have actually lightened up a lot. And it is that segment of the market which actually makes, very aggressive noises when it comes to prices in stock markets. That large HNI segment is today sitting on cash and is what I would say logically concerned and logically bearish. Therefore, the markets aren't in a mood to oblige them.
All right. Hi, Jakes. Since you mentioned the dollar index, and I know you like some commodities, what do you like right now? Vedanta is something I think that you've been quite bullish on. The stock hasn't done much of late, but the parent is getting things in order. And you have a big special situation that's coming up. Has its time come, or is the street concerned about something or the other with regard to the name because of what history has taught them?
I don't like to talk about specific stocks, but one of the things about special situations is today the market cap of a large player like Vedanta will get fragmented into 4, 5, 6 different pieces. When that happens, it's possible that a number of institutional folks may actually find that it is dropped away from the radar of meaningfulness, if you will, and therefore many of the pieces will come up for sale. So while you say it's an important piece and it can generate value, but this is the kind of stock which HNI should savor, because the value of individual pieces will be significantly more than the composite whole today. The thesis is not wrong, except the buyers would be HNI and family offices, and not so much, or individual folks who want, let's say, people want an exposure in copper, somebody wants an exposure, let's say, in metal, somebody wants an exposure in, maybe the infrastructure part of it, if you will. So it's not as though this is a straightforward slam dunk of a situation for institutions, but certainly for HNIs with high dividend, the parent getting its act together, etc. And it must be, taken with the disclaimer that I would or could possibly have an interest. But this is more a discussion, not so much in Vedanta, as the space it is in is actually well linked to a dollar weakness. But the space it is also in is important from a perspective that people who like metals could come into this, and this hasn't performed. So from all those perspectives, it's great. But the demerger itself has some inherent issues of market caps post the individual pieces getting listed.
And though in the last 1 year, it's showing that the stock actually hasn't moved. They've given dividend of around 40 rupees. So you need to take that into account as well. 40 rupees is the cumulative dividend. And at the point that Jakes is making is currently the market cap's around 1,88,000 crores. They have a debt of close to 50,000 crores, which is 2.3 lakh crore. And the estimates throw up that on a consolidated basis, they'll do EBITDA of around 45 to around 48,000 crores, which means the stock is available a little south of around 5 times EV upon EBITDA, which is relatively cheaper. Thanks a lot, Jakes, for joining in. We've taken your disclosure on board as well on that name. We look forward to having a chat with you.
And one final comment, if I'm allowed to have.
Yes, please.
When I got into this, I think I heard Prashant talking about a good-looking screen. I was almost blushing when I said thank you, and I realized he wasn't talking about me.
No, that's
but Jakes, you're on screen. We're on half split screen. I can say it now. I mean,
this is fishing in troubled waters. I'm going to be in trouble.
I'm just going to tell the director to come in there. If anything, let's get Surbi on the screen.
It's a great-looking screen, gentlemen. And on that optimistic note, thank you so much, Jakes.
Have a great weekend. Have a great weekend.
You too. Have a good weekend. Thank you so much for joining in. Let's quickly take a break on that note. Markets continue to have a fantastic session. Look at the Nifty gallop away, 25,500 plus. And now there's momentum. The last little spike is also coming through. We'll take a break, come back and get you more.
Welcome back. Well, it's that time of the day where we go to D Street Chatter. Nimesh joins us to tell us what's going on there. Nimesh, the expiry goes to the bulls. They'll be feeling good. Ending the series on a high is always a great thing. What's your sense in terms of flows?
Absolutely, Nigel. Perfect play to the expiry today. Nifty is up more than 1%. Technically, too, we've been now closing above the very important resistance of 25,350. So clearly, it looks like there is a breakout now on the Nifty, and that can take the Nifty further higher. That's the sense I'm picking up. Flows won't matter much today, Nigel, clearly because of the expiry. So could be all over the place. But from a directional point of view, I think it's the OMCs which are again well bid by the large institutions. You would be an happy man because both some of your sectors are doing good today. Cement is buzzing, so is metals as well. So big moves on those sectors, so to speak. But again, looks like more of an expiry kind of a move. For cement, though, the street chatter or the market feedback is the next big trigger for cement could be the GST rationalization. So if that has to happen, that could be a big trigger for cement stocks. Again, from a direction point of view, I guess there are last couple of days left for the Ps and promoters to sell stake. Post that, I guess the focus will move back to the secondary market stocks. So maybe that also explains in the last couple of days the broader market stocks have started performing, and a lot of mid-cap and micro-cap stocks have started seeing big moves. So that's the kind of feedback. But clearly, the expiry seems to be for the bulls and above the breakout levels. So looks like this momentum can continue.
Okay, well, Nimesh, thanks for that. In terms of specific stocks, what's the buzz?
Well, the first stock is Zomato, which is eternal. Again, it's been long pending, but looks like that block is finally coming in Zomato. Remember, as I've been saying, these are the few days left for the Ps or the promoters to sell. A small stake is left over for a strategic investor that can get sold out very soon. So that's the first name. Second stock is Siemens Energy. Well, the stock has recovered from the listing lows. Today will be an important day because it's getting exited from all the indices, the Nifty Next 50, the Nifty 100 as well. I understand there will be a passive selling of close to 20 lakh shares. But at the same time, there are some domestic mutual funds who are aggressive buyers. And one specific fund has been buying aggressively in the last couple of days in Siemens Energy. So that's the second stock. The third stock is KPIT Tech. Ever since the company announced a mid-quarter update, which is a bit weak, the stock has been under pressure. But for the last 2 days, I'm getting a sense of small buying has emerged from larger FIs in KPIT Tech. And the last is Varun Beverages. In a market where it's all buzzing in trade, a lot of mid-caps are also buzzing in trade. Varun is slightly under pressure today, I guess largely because of the large block offer which has been pending. So it's been indicated that there could be a large block offer, and maybe that explains a bit of softness in Varun Beverages today.
Okay, all right, Nimesh, thank you very much for that. Yeah, it's really actually, if you look at the market breadth today, yesterday, of course, it was completely almost one-sided. Small cap index was up 1.5%. Today, I would say broader markets were much more stronger yesterday. Even though on the Nifty, the gains are much larger today. Look at the advanced decline. Almost overlapping. 1375 stocks are higher and about 1300 stocks are lower as well. So that is the picture at this point. Mitesh is with us with what he'd want you to do with this flourish of a day that we have on our hands. Mitesh, near-term trading ideas?
So I have VTST on Nykaa. I think it's been a stock which has done well, and I've given calls on a couple of times. And now we're breaking out of the 204 half, 205 pivot. So keep a stop at 204. Look for a target of 211, 212. And the other one is VTST on Paytm with a stop at about 908 for targets of 925.
Okay, all right, got that. Thank you, Mitesh, so much for all the calls and the trading advice today. We'll see you again tomorrow. With that, let's move on, putting the spotlight on some individual stocks. Now, Cummins has launched its battery energy storage systems, or BESS, to cater to the Indian market. Vamakshi is joining in with more details. This is a very hot space, Vamakshi. So what exactly is Cummins planning?
Well, absolutely, Surbhi. Cummins who has been actually a leading supplier of diesel as well as gas gensets in India, has now gone ahead and launched BESS, which is battery energy storage systems for the domestic market here. Now, just to give our viewers some context, BESS is a technology that actually stores electrical energy in batteries for later use. BESS can be charged from various sources like the grid, from renewable energy like solar as well as wind, and the energy then can be discharged as far as the use is concerned. Now keep in mind that BESS is an emerging and reliable efficient tech for addressing energy transition needs in key industries such as data centers, commercial realty, manufacturing as well as mining. So thereby you can see how wide the scope of application for this particular technology is, and this bodes well for Cummins because it is a complementary addition to the portfolio. It helps in expanding their sustainable solution portfolio. So therefore it's a positive, and resultantly the stock is up in trade.
Okay. All right. Thanks a lot for that, Vamakshi. Well, let's hop across to the next source-based information we're getting. CNBC-TV18 has learned that SBI has appointed 6 investment banks for a proposed 25,000 crore rupee QIP. Ritu joins us to fill us in with more details. Ritu.
Well, Nigel, that's right. 6 merchant bankers have been appointed for SBI's mega 25,000 crore rupee proposed share sale through this QIP. And we understand these 6 bankers include HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities and SBI Capital, your usual high street bankers. And this comes after the board had already approved this equity fundraise in a meeting last month. Keep in mind, while this board approval for the QIP is valid for 12 months, our sources in SBI indicate the timing of the QIP will very much depend on market conditions. Also keep in mind, this is not exactly growth capital that SBI is looking for. We understand the primary objective of this fundraise is really to augment the bank's capital base. Now, SBI, if you know, its core tier 1 capital is currently among the lowest when it comes to the public sector banking peers, and the idea very much is to cushion that base. Currently, their CET1 ratio is 10.81% and total capital adequacy is about 14.25%. And our sources indicate in the bank that the internal target is to take the CET1 ratio to 12% and the total adequacy to 15% by March of 27, which is where this fundraise is going to help. Of course, we also know SBI is going to get that near 9,000 crores from the sale of its stake in Yes Bank. And then there could be the proposed NSE IPO, which if and when it happens, will also help SBI with capital. Now, if this 25,000 crore QIP goes through, it will be the first share sale by SBI in nearly 8 years and the largest QIP that we've seen in recent times.
Okay, so getting ready to hit the market with that big issue. Thanks for the details, Ritu. We'll keep all of that in mind. For timing, let's go across and say hi to Ambarish Baliga, who's joining us to take us to the final leg of what's been a fantastic day for the market. Ambarish, as we welcome you in. I mean, it's such a strong move, right? 300 points up on the Nifty. The bulls are really charging ahead. So let's start with your stock pick, actually, now that the market is almost getting back to all-time highs.
Right.
What's the stock idea for the day?
Good afternoon, Survi. My pick today is JK Lakshmi Cement. Comparatively a smaller player, but a prominent player in cement markets of North, West and East India. Consolidated capacity is about 16.5 million tons. They have 7 cement plants, 4 AAC block plants and 21 RMC plants. And they have many value-added services and products which actually contribute to about 9% of the top line. Cost optimization is what they've been doing for a while and expected to save about 60 rupees per ton in FY26, about 80 rupees per ton in FY27. And in the next 5 years, they should be nearly doubling the capacity to about 30 million tons plus and getting into the Northeast market in a big way. So that's again the other positive. So expected EPS for FY27 is approximately about 45. And with this, my target price is about 1,035.
Amrish, what if they go ahead and do some inorganic growth?
I mean, if they do that, that's again quite positive because end of the day, whoever is adding capacity, becoming a larger player, I think should be looked at because the cement demand will continue to move up, looking at the way the infra projects have taken off, the way the real estate is going. And at the same time, I don't see the capacity building actually, keeping pace. So after seeing the volume growth in the last couple of years, we've not really seen the margin moving up. So I think that's what we'll see over the next 4 to 6 quarters for most of the cement companies. We'll see the margins going up. And that's what will be a kicker for us investors because we've not seen really major gains in cement space, but that's what we'll see now going ahead.
All right. Amrish, there were a couple of other positives that came out today from the broader markets. I'm not sure whether you track Lloyd's Metals. It was on expected lines that they were expected to get the permission to mine more. Last year, they sold 10 million tons of iron ore. Now, this year, they were optimistic that they'll get higher, permission to mine more. And that's come about. So this year, it'll be 25 million tons. But it's not a surprise because the street was anticipating that. They've given a guidance on around 23 million tons.
Absolutely.
Any view on this name or the smaller player, which is Lloyd's Engineering Works? That will do some part of the work for Lloyd's Metals. I think their order book is around 1,300 crores. Out of that, 45% is from Lloyd's Metals itself. Any view on either of these two names?
No, Lloyd Engineering I really don't follow too much, but yes, I mean, looking at the order book, which is again mostly in-house, I mean, I would normally not look at companies like those. But Lloyd Metals, I think at these levels, with most of the news which was clearly expected, has happened now. So I don't see too much of an upside from here. It's already, I think, closer to a 52-week high. And because of this news, possibly we could see either 100, 150 rupees more. So I would really look to buy at this point of time.
Look to buy, right? Lloyd Metal.
Yeah, I would.
All right. So you believe bulk of the good news is in the price. Got that. You know, what supports them is the volume growth and the cost of mining. But as you said, the stock, I think just around 3-4 years ago was a 250 rupee stock, which is currently at around 1,550. So Ambarish's call is he would stay away from this name because most of it is in the price. Well, time to slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all of this at your fingertips. Download the CNBC-TV18 app now from the Apple Store or from the Google Play Store. Or simply scan that QR code that's up for you on the screen.
Welcome back. Well, galloping along 300 points higher. That's what we have on the market this afternoon. Mid-cap index a little behind the large cap screen, but the large caps are really on fire today. That's the kind of session that we have had. Amrish is still with us, and by the way, a lot of financial stocks are doing really well this afternoon. Banks and non-banks. Shriram Finance, Jio Finance, Bajaj Finance, HDFC Bank, HDFC Life, Axis Bank. It's a full green screen when it comes to financials today. Amrish, give us a pick in this pack.
In this pack, there are a couple of picks. After a long time, again, HDFC Bank, again, it will benefit from this sale of equity in HDB. And at the same time, stocks like ICICI Bank in the PSU space, SBI, BOB, PNB, which again hasn't really performed too well in the recent past. I think that's another pick as far as I'm concerned. But nothing much in NBFC, but mostly into banks.
Amrish, any view on Tube Investments? It's up close to 5% after a while. It's come on the radar.
Yeah, but I really can't comment on this group since my brother is an independent director with that group.
Okay, all right. Taken that on board. What about a couple of other names? UPL, the street is fretting something on this name. And that's why earlier this morning as well, the stock was down, I think, 3% in the first 30 minutes itself. There were some on the street that were bullish, at around this 600-700 rupees. They were saying how much of the bad news is in the price. Even after various restructuring and all sorts of things, repaying debt, the street is not willing to give it a value. What's your take?
I think the debt burden, which I think is a major negative. And at the same time, every time when the earnings are being declared, there's an expectation that the worst is behind and things should improve going ahead. But again, we have, hardly got any positive surprises from this group. So again, I don't see this stock going much beyond 700. I think that's where it gets stuck. So as traders, I think one could look at buying at closer to about 600, 610, and looking at an upside of about 670, 680. But for an investor, I think like an investor could really get tired. Waiting to see this stock perform.
Look at something like a Pakka Packaging. For 14% higher. That's P spelled PAKKA. On the NSE, we can pull it up. I remember SBI Mutual Fund picked up about an 8% stake sometime back. I was the talk of the town back then, but really a big fall. 360 levels back in December of 2024. It fell to about $150. And from there, it's making a bit of a comeback. I don't think we've still found PAKKA, if we have it, on BSE or NSE. Anyway, I don't think we'll add that to the list of stocks we can show. Nuvama is up 5%, 7908. That's doing well after a while, I think. And Hindustan Copper is another name, 5%. Lots of action actually. But it's, I would say, in the intensity and volume of the broader market action, it doesn't match to what we saw in terms of trade and what we had yesterday. MobiKwik, First Try, etc. Of course, we've been discussing earlier on as well. On the downside, lots of names, but Infibeam is the big one. But again, it's a small stock now. But third largest volume-led loss on the NSE now, 17% cut. Any thoughts on Walkhard? This again has been one of those rocket moves, Amrish. I know you typically don't like to look at these kind of names. We've already done very well. You try and find stuff which is done poorly and is ripe for a bit of a turn. But any thoughts here?
No, I really don't track Walkhard very closely, so it's difficult for me to say anything about it.
Do you track a company called Panacea Biotech, Amrish?
No, even that, unfortunately, I don't track.
I see. Got that. No problem. I don't know if Nigel has already asked you about defense. Anything on your radar? Or again, too hot to handle?
No, the valuations are a bit too high. And I would say that possibly execution could be an issue going ahead. Because sort of orders which they have got, I don't think their capacity can really take care of the order flows which you have seen. And the market, unfortunately, has only discounted the order flows. They are still not discounted the execution risk. I mean, we have seen that execution risk as far as HL is concerned, and when that came to the fore about the Tejas delivery, the stock had corrected again. From there, it's moved up because it's more of sentiments which are playing on the defense. I mean, if you're talking of the next 5-8 years, yes, I mean you need to be positive on the defense stocks, but then at a price. So at these levels, I'm finding them quite expensive from an investment perspective. But for a trader, clearly, I think it's in their favor. The momentum is on with so much of geopolitical issues which we are seeing. I mean, there would be interest continuing in defense, but I would possibly stay a bit cautious as an investor.
Okay, all right. Amrish, thank you very much for all the perspective today. We'll quickly recap what's been a fantastic day for the bulls. Look at the market go, 25,549. The bulls punching through the trading range, really slamming through it over the last 2 sessions. So the Nifty winners today, like we were just discussing, lots of the financial stocks have done really well. Shriram Finance, Jio Finance, HDFC Bank, HDFC Life, Axis Bank. So financials are running along. Global facing stocks, particularly metals, very, very strong today. Tata Steel, Hindalco, the gains are almost 3% on these stocks. Then you have names like Bharti Airtel, 2.5% higher, Reliance, 2% higher. So all the big boys standing up and being counted. L&T, about 1.5% up. ITC, just go on. It's a long list of winners on the screen. On the flip side, actually not too much complaint on the Nifty at all. Dr. Reddy's, because of that City note, which is a little bearish on the stock, down 1.5%. And relatively speaking, IT was a little quiet. Tech Mahindra, Wipro and TCS, all of those stocks have a smidge of red on them. But it's not a day to count the red. It's all about the green this afternoon.
Then let's give you some green. Orbit Exports, that stock was up close on 20%. It's been a while since we looked at this one. Brainbees Solutions up 17%. Jai Balaji up close to around 14%. Remember, these are names we don't talk about on a day-to-day basis, but there were massive volumes on these names. Aztec Life Sciences, well, that one was up more than 10%. Centim Electronics up another 10% in today's trading session. Lloyd's Engineering Work up close to around 9%. Lloyd's Metal has the positive, announcement today, but Lloyd's Engineering Works did very, very well. So that stock as well, up and about. All in all, a rocking trading session for the bulls. They end the June series on a high, go with gains of around 300 points, and the Nifty Bank got into form late in the trading session, but that as well goes home with gains of around 600 points. We'll wrap up on this edition of Closing Bell. Stay with us. Markets Forward comes up next.